So when you own a company, you're going to have expenses, right? Like you're going to have things that you buy for the company, blah 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 blah. Now these expenses will generally fall into like a short-term expense and a long-term expense. A short-term expense would be something you can think of it like something that you can only really use once, something that's not going to benefit you or your company over the long run. Whereas a long run expense, which is actually called a capital expense or a capital expenditure, those are things that you're going to benefit from many years. For example, if you buy a car, you don't just use a car for a year or less, you use it for a long time. So things like that are capital expenses. Let's say you buy a computer, right? A computer doesn't just last you for a month, unless you're just going to sell it to somebody else. It would last you for a long time. So things that last you longer than a year that you're going to use in the company, those are capital expenses. Let's say you own a bakery and you buy a furnace, for example, right? If you own a bakery, you buy a furnace. That furnace you're not just going to use for like 1 month or a couple months. You're going to use it for like 10, 20 years. So the first way that you got to understand the difference between free cash flow and earnings, first you got to understand that some expenses are short-term expenses, other terms are longer-term expenses, and those longer-term expenses are what we call capital expenses. So let's do a little test. Let's say you own a pizza shop, right? And you buy cans of Coke to sell to your customers. Well, that wouldn't be a capital expense. That would be, a short-term expense because you're just buying, and the expense is just that you're going to now sell it to the customers, right? But let's say you buy a fridge to store the Coke. That would now be a capital expense because that fridge is going to last a long period of time, over a year, right? So when we're looking at a business, right, the major difference between earnings and free cash flow, like basically the biggest major difference most of the time is going to be how those capital expenses are considered. So those long-term expenses, how you consider them and how you expend them is difference between earnings and free cash flow. Watch what I mean. Let's say hypothetically your business makes something like $200,000 a year in revenue, right? So it makes $200,000 a year in revenue, let's say, hypothetically speaking, okay? So your business made $200,000 a year in revenue. Your business buys a truck, okay, for $300,000. It had, let's say your business had enough cash to be able to buy the truck, even though the truck costs more than your revenue. $300,000 is the cost of the truck, and you just buy it outright, right? Let's say your business had some extra cash, whatever, you bought it on credit, I don't know, but you bought $300,000 truck. So your business does $200,000 of revenue, but you bought a $300,000 truck, right? Now, in terms of earnings, what happens is because you bought a truck, right? The truck benefits your company for longer than a year, so it would be a capital expense. You see what I'm saying? So now this $300,000 in terms of earnings, it's not like you subtract it from this $200,000 and say your company has a $100,000 loss. That's not how it happens for earnings. How it happens for earnings is you take the amount that you spent and you divide it by the estimate life of the investment. So let's say you buy a $300,000 truck, right? And let's say you're saying, this truck will benefit my business for 10 years. Let's say hypothetically, just keeping it simple. Then what you would do is you would take this $300,000 and divide it by 10. And from each year for the next 10 years, you would subtract $30,000 as an expense. So for this $200,000 of revenue, now you'd be subtracting 30,000. You would wind up with a 270, or sorry, a $170,000 earnings for the year. You see what I'm saying? So what we're doing here, basically, is we have, so it's 170,000. So our company made $200,000 in revenue, and we bought a $300,000 truck, right? Now, the truck will benefit our company for, let's say, 10 years. Let's just imagine that 10 years is the depreciable life of this thing, okay? What we do is we take the 300,000 divided by 10. That gives us $30,000, which we're going to subtract every year for the next 10 years from our company's revenues to give us our profits. So that means that we profited in terms of our earnings $170,000. Okay, $170,000 would be our profit, right? According to this formula. Now I know you're thinking to yourself, but how do you make a profit If you only brought $200,000 in revenue and you bought a $300,000 truck, you lost $100,000. Where's the profit? That's why earnings are nonsense. Kind of like they're not that, they're not that important because look, it's saying we made a profit, but in reality, if we look at the free cash flow, to get the free cash flow, what we do is we take this $200,000, right? Let's say, and we would be subtracting the $300,000, and we would wind up in this case with negative $100,000 of free cash flow. Now, how this is done in real life is actually a little bit different. In real life, the way that you do this sort of like from a sort of accounting perspective is you take this $170,000, you add back this, so 170 plus 30 will give you 200,000. So what you're doing is you're adding back the depreciation. So you take your profit, add back depreciation, $200,000, and subtract your capital expenditure, which was 300,000 minus 300,000. And that would then give us a negative free cash flow for the company of $100,000 per year. So do you see why free cash flow is much more important than earnings? According to our earnings, right, our profit was $170,000 a year. Because what we're doing is we're taking our big expense and depreciating it, dividing up the cost over a 10-year period, let's say. Okay. But in terms of free cash flow, our company's showing a loss. That's why free cash flow is much more important than earnings, okay, from an investing perspective. So I hope this explained it. I hope I explained it well to you here. I hope you can understand the point that I'm trying to really convey. So keep in mind that the actual cash that's free at the end of the year is the free cash flow. The earnings, they could be sometimes an illusion. Just because a company is saying it's turning a profit doesn't really mean that much. You have to look at the actual cash flows of the company and see where it's spending its money. So look at this company here. Like I say, you have $200,000 in revenue, but you bought a $300,000 truck. If you write off the truck, this $300,000 over 10 years, that means you subtract $30,000 a year. That would give us still a $170,000 profit. If now we want to look at the free cash flow, what we do is we would add back this depreciation expense. That would give us $200,000 again. We subtract our capital expenditure. That means now we're losing $100,000 a year, right? $200,000, but you're spending $300,000 means you're losing $100,000. It's just common sense. Free cash flow is a much more important metric when it comes to evaluating companies than earnings. Keep that in mind. I hope the video was informative. Be sure to like and subscribe and leave a comment if you have any questions. Thanks.